Kitco Mining, special coverage of the National Bank of Canada Capital Markets CEO Mining Conference, is brought to you by Agnico Eagle.
Mining M&A is heating up. Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 NBC Capital Markets CEO Mining Conference in London, England. Joining us today is our host, Elian Terner, Managing Director and Head of Global Metal and Mining Investment Banking at National Bank Capital Markets. Bit of a mouthful there. Elian, welcome back to Kitco.
Thank you, Paul. Great to be here.
Now, we're sitting here at your event. Thank you very much for the invitation. A great event. It's been very successful for us. We've had a lot of good conversations with CEOs. The CEOs really seem to enjoy this event and seem to get a lot out of it. And I think it's a testament to the growing interest in the mining space amongst the investment community. Let's start with this event here. How has the event, how has that evolved in recent years?
Thank you for asking. And so National Bank, starting point is National Bank recently celebrated its 50th anniversary in London. There was a big function just last week. So long-standing presence in the UK and then by extension the continent. National Bank's mining conference started some 12 years ago, and it started as a joint effort with the TSX. So the first construct over the last, call it 8 or 9 years, was a construct of delivering Canada into the UK and, as I said, by extension, the continent. And so the premise of being invited to the conference prior to the change I'll describe in a second was Canadian gold companies with an asset in Canada. Subsequently, over the last 3 years, we have changed the profile of the conference, whereby we dropped the requirement of gold and dropped the requirement of a Canadian asset. And that opened up, obviously, the playing field to us and was really a reflection of our business and our practice, which is a globally relevant mining practice. So that first year in 2023, we went to 22 companies and we made it at least CEO invitation only. And today we're at 40 companies, and we straddle everything from the largest companies, be it in the gold space with Agnico and Alamos as examples, to Wheaton Precious and Triple Flag, Gold Royalty on the streaming and royalty side, down to the exciting developer set, whether that be Snowline or Bravo, just by way of example. And so each of these companies has their CEO here, and then as well we'll usually have at least their IR professional and may have their CFO, et cetera, with them. So it's now been labeled by people like Paul Rollinson and Michael Steinman as one of the most important conferences on the circuit on an annual basis, and we're very proud of what we built together across the team. And so last night we had our dinner with over 100 people attending, and really proud of what we've put together here.
Well, congratulations. I think we'll do about 15 CEO interviews, which will be available on our YouTube channel for people to look at. Let's talk a little bit more about the London mining finance scene. The city has lost some big listings over the last year or two. This event seems to be going from strength to strength. So, what's your interpretation of what's happening in the London mining finance scene? What's its appetite for mining investment?
It's certainly growing, and London is a global finance center, a la New York, a la Hong Kong, as an example, in comparison to a mining hub such as Toronto or Perth. And so it was inevitable as the commodity cycle turned that these communities, whether that be New York or London, would turn on as well. And so certainly we're seeing that in New York with a lot more cross listings now from the TSX to the NYSE or to the NASDAQ. And those have been successful progressions and added liquidity and interest to the stocks that have done that. And the same thing in London. We're not seeing the dual listing per se, but we're seeing the pockets of capital growing in there and wanting to invest in ever more depth into the mining ecosystem.
Where is that sort of investment interest coming from? It's a sort of, let's say, a worldwide phenomenon that the mining specialist funds are shrinking. There's fewer and fewer of those. So where's the sort of new investment interest coming from?
Well, it's true that some of the resource funds, traditional ones, have let's say not grown per se, but new ones have been started, maybe with a different thematic than just long only. So a little more opportunistic, if we may call it that. But of course, again, the generalist investor cannot ignore thematics that are there. So obviously, the biggest one that everyone's talking about is AI, and so if you're a generalist portfolio manager, you have to think long and hard of how you're in it or out of it, as the case might be. And same with mining. I mean, when you read your Financial Times, your Wall Street Journal, your Globe and Mail report on business, and you're seeing $4,000 gold every day, it doesn't matter that you were not in it 5 years ago. You're going to pay attention when the gold price has essentially doubled over the last 12 months. That's an investment opportunity as a generalist that you need to at least understand and probably make a call on at some point.
I think that's definitely been a theme of the year, isn't it? Because even blue chip companies in the gold space, like our sponsor here, Agnico Eagle Mines, their share price is up more than 100% year on year, and investors can't ignore those kind of share price gains.
No, because a group like Agnico or Newmont or Barrick, of course. These are the largest, most liquid names in the sector. So when somebody's new to the sector, they're by definition going to go to what they see as the place of safety, and liquidity will be their number one box ticking exercises. If I go in, how quickly can I get out?
Okay. In addition to organising a great conference, barely a week seems to have gone by this year without a major deal or financing being announced with NB Capital Markets involvement. Congratulations. It's been a very, very busy year for you, Elian. What have you been most pleased by, and what have you been surprised by this year?
Well, thank you for saying that, and we're very, very proud of the momentum our practice has, globally speaking. So this year was a record year for us. Of course, the street would have had an on-block record year. I think our practice took more than its fair share of that activity. It was on the investment banking side. It was a very balanced year between equity underwriting and raising and M&A advisory. And then our lending practice has also grown again. We were greenlit for an expansion of our lending book. We are in our minds, probably the top 2 lender amongst the Canadian banks. And it's a globally relevant lending book, whereby we'll lend from the largest multi-diversified mining, be a senior lender to one of the largest multi commodity or multi-mining companies on the planet, to being a single asset lender in North America or other places around the world. And so, all of our vertical is firing on all cylinders, whether that be sales and trading. We've increased our research coverage. We have one of the largest developer coverage universes now amongst our Canadian peers. And as I said, a globally relevant balance sheet. We're very pleased. Every client of ours, as I always say, is our most important client. But this year we happen to have been in the fold, in the mix on some of the largest mergers that were affected. Just to call out a few, we had the privilege of advising First Majestic on their acquisition of Gatos. We advised Pan American on its acquisition of Mag Silver. That was earlier in the year. And then most recently, we advised New Gold on its sale to Core. And so those would all be, natural consolidation stories, if you will, the A plus B that, has long been talked about, sought after, and will always happen ultimately in a commodity business like mining. We also were involved in some very exciting developer M&A. Amongst others, we advised Augusta Gold on its sale to Anglo. So Anglo consolidated some of its position in Nevada. And we were also involved in the New World Copper situation, which became a really exciting bidding war between Central Asia Minerals and Kinterra, which was the successful bidder there. On the equity side, we were fortunate again to lead some of the largest deals that transacted in our sector, led by Perpetua. That was earlier in the year. It was a $375 million U.S. transaction. We led there. We did financings for Allied, which is a company we took public a few years back. We did financings for I-80 and Osisko Development and Highlander, so all interesting and exciting developer and emerging stories, if you will. And so, our practice, I think I've said this before, what the hallmark of our practice is we can be anything, your biggest bank practice can be. We have the balance sheet, as I described. We have a global footprint, and we have a global network of relationships and advisory assignments that we can point to on that front. But we can be as aggressive, nimble, and creative as any of our independent brethren. And we respect the whole ecosystem because we think every segment plays a role, and we want to be involved in the whole ecosystem.
Okay. I want to follow up on a couple of points you touched on, Elian. In terms of the financing, this year's been noticeable. There's been some much bigger financings, and there's been a lot of bought deal financing. So, what is it you think investors are looking for now, today, which they perhaps weren't interested in, a year or two ago?
It's a great question because we were recently looking at the data, and what we found was last year it actually was a equity environment for the larger cap names. So a lot of balance sheet cleanup or growth equity, and again, as the cycle was turning from bear to bull, that was the starting point, was to go into financing and raising money for the larger companies. This year, most of the equity activity has actually been on the developer side. So you can call it, a good sign of being more in a bull market where the risk trade, if you will, is more prevalent. People understanding that the development cycle needs to turn back on. The juniors have to get money to continue exploring, developing, so that ultimately our intermediate and seniors can replenish their cupboard, so to speak.
It does seem that with the higher gold price, with the higher silver price, with the higher copper price, there are more financing opportunities available. One of the companies that was supposed to be here, but I understand is not, because they've just closed a big $300 million financing, Vizsla Silver. They decided to do a convertible 5% coupon for a development asset, which is pretty amazing when you think about it.
Yeah, absolutely. And it just speaks to where we are and the kind of capital across the balance sheet that's available.
Okay, let's talk about M&A, particularly M&A in the gold space. You've been very involved in that. You're currently advising New Gold with its merger or the takeover by Core Mining. New Gold has had a spectacular third quarter financial results. They brought their all-in sustaining costs well below $1,000 per ounce. There's only a handful of companies that can say that now. And I would have thought there'd be much more competition for a sub $1,000 per ounce producer. Why aren't we seeing bidding wars? Why aren't we seeing M&A heating up and getting to bidding wars in the gold space?
Well, we can't say there wasn't competition for New Gold, so let's start with that. But New Gold is in a unique situation. The management team led by Pat Godin had done a great job over the last couple of years of really positioning those assets and finishing up their capital spend is really what's transpired here. So they are truly at an inflection point, of very significant free cash flow generation. As a result of that, they were trading at a very high multiple. So what that means is the universe of potential buyers, in order to affect a accretive transaction, would also have to be trading at a relatively higher valuation to where New Gold is, and so that universe is narrower, and it's because only certain companies get to enjoy those valuations, and Coeur was one of them. They as well, having gone just through a significant capital spending period led by Rochester, were now coming to their free cash flow inflection point, and so that's why these discussions made a lot of sense. Coeur looking for growth, New Gold open to different alternatives, whether being a sale, merger, or an acquisition. All of these were contemplated, of course, and ultimately Coeur and New Gold found a deal that they believed made sense for their combined shareholders. And so what we believe is that the pro forma company here, the new Coeur, will enjoy significant free cash flow, which we'll start to see next year. And I think the industrial logic of this transaction will become very clear.
Okay. Now, obviously, we're talking about mining, so we're talking about companies depleting resources, and it's been well sort of voiced about the lack of exploration. There's a lot of companies aren't replacing the ounces they're producing. Do you see the M&A space heating up going forward because of that?
Certainly. I mean, I think, again, developers are only human. So they've been toiling without capital, with depressed investor interest. And here they are in an environment, as I just said, where they're getting replenished coffers to do their work. By extension, that would suggest that they're getting replenished valuations that give their assets and their work better valuations. So they're at a better place to even contemplate M&A, which means that their valuations are starting to reflect their fundamental value more. And by extension, the intermediate and seniors, they themselves have the increased valuation because of all the things we've said to look at that kind of M&A. So, developer M&A is certainly on the table. It always is. But I've said this before. If you look at historical M&A charts, you will always find the most robust activity is always in peak valuation moments. Everyone likes to think the trough is when things get done, but it doesn't work that way. There are deals that will happen in the trough, but those are deals of distressed and must do. But when we're in a valuation cycle like we're in now, and certainly we think there's more room to grow, we would expect more M&A.
Okay. Another trend that's very clear this year is the increase in shareholder returns. Through the third quarter, returns are already in excess of what they were last year. So it's going to be a bumper year for shareholder returns, with dividends once again seeming to get the upper hand over share buybacks. Does this suggest that companies now see that they are trading at fairer valuations than they were perhaps last year? Are fewer CEOs claiming to be undervalued now?
I think that's right. I picked that up. If you're referring to Colorado Springs and Beaver Creek, I did sort of pick that up myself, that there were fewer people complaining about the lack of investors at these conferences or their valuations being super depressed. So that's a good sign. And so, yeah, I think we are in a better spot there. On the dividend point, it's an interesting point you make. We've done a lot of analysis on this, and our partner in Vancouver, Morton Eisenhart, has a very sophisticated model that he continuously updates for valuation parameters. And over the years, one of the key factors he keyed in on 4 or 5 factors, at the top of that list would have been scale. And that made a lot of sense in a more depressed environment where scale, as I said earlier, leads itself usually to liquidity and then the ability to come in and out of a story, if you will. What we're seeing today is dividends is at the top of the list, the return of capital, as you say. And so if you look at just one name, and there's others, but I think most people would agree that at the top of that list is Lundin Gold, producing very significant free cash flow, but also returning it. They had 100% distribution of their available free cash flow last quarter. And they are trading, as a result, correspondingly very, very well. So investors are very much rewarding that return of capital.
How long, I mean, that's a very interesting point. How long do you think that becomes more normalized across the sector? Because a lot of companies, their dividend yield is 1%, 2%. A good company in the gold space perhaps gets a 3% yield, which in the grand scheme of things isn't that necessarily exciting or attractive. As companies, pay down their debt, they invest in their sustaining capital and perhaps growth capital, they're still growing capital on their balance sheet. I think there's 8 companies now that have got more than $1 billion sitting on their balance sheets. At what moment will companies in general start returning much more of their free cash flow to investors? With companies like Lundin Gold leading the charge, will it pull other companies to have to do the same?
Well, they're certainly noticing it. I mean, that's for sure. It is a tricky question because the mining industry, like the oil and gas industry, is a depleting resource business. So every single day, you're essentially killing your inventory, and you need to think about replenishing it. And obviously, that requires capital. So, in general, I would think that if people feel that access to capital, all else being equal, is easier than it has been, whether that's equity or debt capital markets or lending markets, that probably will underpin the ability to return more capital. But if people's views are that those markets aren't necessarily as open to them as they are for others, then they're going to protect that capital to, first and foremost, reinvest in their business.
I think it's an interesting comparison with the oil and gas sector because, the oil price has been under pressure. It's $60 a barrel. It's far from the situation the gold sector's in. And yet oil and gas companies, their dividend yields are 4 to 6%. So perhaps a page the gold companies can take out of oil and gas.
I agree.
Okay, let's talk about some of the other big news this year. Obviously, the gold price hitting $4,000 is one of those. Mm-hmm. We've seen Newmont complete its mine divestiture program, creating a number of new mid-tier gold producers. We've seen 3 or 4 significant CEO transitions at the big gold producers. We've seen stablecoin company Tether invest in the space. It's got investments in, I think, at least 3 royalty and streaming companies. More recently, the news is talking about the potential breakup of Barrick Mining, and of course the $53 billion Anglo-American tech merger is on the table. What for you have been some of the principal themes of this year?
I think Tether is a good one to start with. I think their entry was, call it a surprise, but not unexpected once you peel back the onion, so to speak, on what their business is and the notion of converting their dollars into hard assets like gold. Some might say they are a form of new generalist, if you will, and have an understanding of hard assets that's unique and positive in general terms. They are not the only ones. There are others from, let's call it the stablecoin, Bitcoin, crypto world that see the same thematic and are wanting to take advantage of it. So, a transaction we led for Osisko Development, did have an investor of that background in the transaction and somebody that's looking to deploy more capital. So we think, again, these groups that have enjoyed a run in the Bitcoin price, just to name one of the alternatives, are always going to have their eye on gold, because as we've seen recently, the volatility in those markets is still very high. Even though they've enjoyed a really nice run, they came off recently in a much more violent way than the gold sector. And so again, it speaks to just the history of gold as being that alternative hedging, protection, asset class. So I think that's interesting. Of course, we're watching the Anglo tech situation. I don't think it's done yet necessarily. I mean, we understand BHP off of the most recent news has said that they're not going to pursue it anymore. But there are others that make sense. And I wouldn't expect that we might get some other news here over the next few weeks about people wanting to see if there's an opportunity for them. So we're watching that. The consolidation theme, I think, is going to get more heightened. And like I said, the M&A environment as we enter the next phase of this bull market is just going to pick up. It's just a natural extension of where we are in the cycle. And then finally, we're touching on the Middle East. You and I met at FMF earlier this year. We'll be returning there this year with a bigger presence. National Bank is opening an office in Dubai in January. Before this conference, I was in Dubai with other colleagues, taking our fifth group of mining CEOs through the region. And we don't think that's just getting going, if you will. I think the groups in the region are still trying to figure out what it is that their strategy is, but their overall thematic of critical minerals or investing in the mining space is alive and well. I think what's happening is they're fine-tuning their strategies and business plans, and I expect that we'll see more transactions outside of the region from some of these groups in the next year.
Okay, I just want a little bit of follow-up there, Elian, if I may. With the stablecoin Tether investing in the space, the reasons for that are very clear. They obviously want to back and hedge what they're doing with hard assets. Playing devil's advocate, they've been buying into royalty and streaming companies. Given that they are big buyers of physical gold, wouldn't it make more sense for them to buy a gold company, buy Agnico Eagle, and instead of paying $4,000 per ounce of gold, they're getting it for cost of production, which is $1,000 per ounce?
Sure. I mean, I think that's a reasonable proposition. But at the end of the day, I think we can agree that royalty and streaming companies are financial entities in their essence. Tether and other groups like that would see themselves as financial players. And I think they will be more easily understanding the streaming and royalty business and model in the first instance. And they're just getting started. I don't know this for a fact, but you're right. I mean, the next leg is if they do consolidate the junior space, might be to then take it one level up or down, to being in the mining business themselves.
Absolutely. Big question here. It's been a very busy, interesting year, 2025. What do you anticipate being some of the key themes for 2026?
I think one of the themes we think will geopolitical situation. The geopolitical situation right now is obviously driving a lot of things. In the first instance, it's driving the gold price. It's not the only reason. We know there's the de-dollarization thematic, tariff wars, et cetera, that have put the gold price in the position it's in. But if there is further geopolitical calmness, if you will, like we're seeing this week, potentially a peace accord being signed with the Ukraine and Russia, that's certainly going to stabilize. We would believe it would stabilize the gold price. It doesn't mean it's going back to, let's say, $2,000 level, but it would take some of what's driving the gold price out. And by extension, that would be good, because one of the things we believe why we haven't seen as much gold M&A or other precious metals M&A is because of the volatility in the gold and silver price. It makes it very difficult to put a price in a model when your spot price is running so hard and fast versus consensus. And consensus can only run so hard, with spot. That's natural. So if we see some of that stability, it'll make it easier for consensus to either catch up or the gold price to come down, whatever the case is. And that will allow for more constructive arguments about what the price should be when we're trying to affect M&A. So I think that could be a positive result out of a settlement of the sort I just said vis-a-vis Ukraine and Russia. And then, of course, with that negativity out of the market, so to speak, that negative geopolitical situation out of the market, it should buoy the base metals construct and complex. So, for example, copper, not that it's not strong, but might find itself having another leg as people start to believe in global growth again. So I think, we're watching that closely because we think those two things are good for our market, healthy and good for our marketplace.
Well, as I say, it's been a fascinating 2025. 2026 looks like it's going to be a cracker as well. Congratulations on a great year and a successful event. Elian Terner, thank you very much for joining me today.
Thank you, Paul. And
we have a lot more to come from the NBC Capital Markets CEO Mining Conference here in London, England. So stay tuned and hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining, special coverage of the National Bank of Canada Capital Markets CEO Mining Conference, is brought to you by Agnico Eagle.